Hi guys, good evening. Let me set up the yeah. Hi, Mr. Surgery. Hi, Surat, CN, Francis, Mihir. Good evening, Duckets, Shri, Mitchell, Charmi, Vivek. Yes, we can talk about Bank of England as well. Today's analysis is more focused on the impact and how we should read that data, not on the stock level, because it's going to be very difficult to trade the volatility. So it's better to understand the index and then make a trade out of it. Like the same thing which we did today. Uh, so we still have 1 minute. So I'm going to grab some glass of water and then I should be ready. Give me 1 minute, guys. I'll be ready in 1 minute. Okay, I'm all set. So tomorrow is two economic events. Uh, so let me use the whiteboard first before we uh, do anything. So I'm going to create a whiteboard. So tomorrow we have PPI at 8:30, which is purchasers price index. Similar to the definition of consumer price index, this is the information which excludes food and energy. Again, let me also, I'm using the whiteboard. I'll show you later on what exactly the definition is and what are the expectations of, let me do that. Let me open investing.com. Economic calendar. And I also want to open Investopedia because many people have issues understanding what constituents uh, CPI, what constitutes in PPI. So give me 1 moment. I'll open all the definitions and then we'll talk about how it is calculated, how it is measured, what could be the impact, so that when you are reading the data, you will have a clear idea. So I'm stopping this whiteboard and sharing the screen for a moment. So this is Investopedia website. Again, people who are totally Vivek, yes, I stopped sharing the whiteboard. You should have uh, Investopedia. Let me just give a couple of seconds so that there's no lag, and then we can talk about purchaser price index. So you can see on your screen a website, Investopedia. Anybody who is totally new into the trading or who is struggling to understand the basic definitions should refer this website for sure. This is a really, really good website, gives you details of how macroeconomics are defined, what is covered in each of the macroeconomic event. And then once you have a basic idea of it, you can start to relate how the market is reacting to those economic events. And this is really, really useful in your sense of market, plus it adds to your knowledge. So producer price index is measure the change in prices paid to the US producers of goods and services. So this is like a wholesale price which was given to the producers. And then those producers sell that product on the retail stores, which is then bought by the consumers, and the prices paid by the consumer becomes the part of the consumer price index. For example, let's say a factory makes a t-shirt, okay, and that t-shirt is $9.99 at the wholesale. So what producer does is collecting all the raw material and everything, he gets the product, and that cost was $9.99. Now he sells that product into the market, maybe at $25.99, $24.99, maybe at $19.99. So if there's the increase in the prices of the raw material, the cost of labor, the cost of services which are coming as raw material to the producer, he is going to pass that on. In some cases, he does not. He keeps it because the margin between his price and the price which is sell to the consumer is very big. Sometimes they accommodate that. So PPI is the price which is paid by the producers of goods and services. Very first thing. It gives you a clear idea, not a 100% idea, but a clear idea where CPI is heading. As I said, because PPI may not be 100% passed on to the CPI. So PPI is a measure of wholesale inflation, while consumer price index measure the prices paid by the consumers. So wherever you see the wholesale, like in India, when I learned about this CPI, we used to call it WPI. So it was wholesale price index, and this was consumer price index there. Here we call this as PPI. Now they are calculated on product and services, industries, buyer's economic identity, overall monthly change in the final demand. And they are also based on the contract prices, like they are raw material contracts which are negotiated by the suppliers to the producers over a period of time. If they, and usually they are 3 months, 6 months, 1 month, 1 year, these kind of contracts. So if the prices are negotiated well and settled, there's very little possibility of those prices going high or low during a particular month. So we need to keep this thing in clear mind. This is what we use to figure out a purchaser price index. Again, it's the price which producer pays for all the supplies he gets, the cost for the producer, or the inflation at the wholesale level. Now, what is the expectation for tomorrow? So tomorrow, the expectation is that wholesale price index, which is PPI per month, forecast is it's going to increase by 0.2%. So it shows that yes, there is expectation that yes, PPI is going to increase. And that was the reason that we saw the nervousness in the last half an hour, where market was around 36.10, 36.15, and all the way it went down to 35.80 and then bounced from there. So markets is really, really nervous on the PPI, on the inflation, because if it comes higher, as I said, PPI gives you a direction towards the CPI. If PPI is higher, then you can clearly mean that yes, there's a very high probability CPI will also come higher. They are not 100 one-to-one relationship like in the terms of percentage, but yes, certain like 60 to 70% increase in PPI will constitute some increase in CPI. Now, what is my expectation? I think the prices of raw material, because the inventory is getting, like if you look at all the retailers, which are the bigger portion of consumer, right? They all are loading the inventory, or they are filled with inventory right now. They are not selling at a higher prices. So there is a very high probability tomorrow morning that yes, the PPI may not be higher. It may be actually flat to negative. Why? Because consumers are spending less. Last month, when the PPI was negative, we had the school reopening. So there was a good amount of purchasing and consumer activity which was happening across the US. But this week, we do not have any big, or this month, we do not have any big event which will lead to the consumer spending. So the inventories are getting higher and higher on the retail side. It could be any store, it could be Walmart, it could be Target, it could be Nike, it could be Under Armour. Any of these retail stores, they are getting more and more inventory. And as a result, the demand for the raw materials should ease off. This is called deflation, that the prices is not going down, but the demand is going down for the raw materials. So I am expecting flat to negative PPI. That is the very first thing. Second thing, how would it pass on to the consumers? Consumer also in CPI also include a big portion of the retail prices, about 95,000 retail stores across the US. Also about 45,000, I'm giving you a rough number, 45 to 43,000 rental prices, where they check and evaluate whether the rental prices have gone up or not. I don't think so. That is going to have an impact on the PPI. So PPI may actually be a little lighter on the positive side. If it comes lighter, it will give a thumbs up to the market that yes, they can take a cue that CPI will not be as bad as everybody's expecting. Okay. So this is all about PPI. Anyone has any questions regarding this? Let me know. Otherwise, I'm going to move. And I'm also sharing the Zoom link right away, because if anyone has any questions regarding this, you can come on and talk rather than waiting, because I do not want to deviate from this topic. I've shared the link. It's on the YouTube chat. You can come and you can then ask anything regarding the PPI. Now, the other important event is at 2 o'clock Fed. Now, Fed is very, very clear that inflation is their problem. And in order to address inflation, they have two options. Number one option, now in this case, I'm going to go to the blackboard, or I can go to the paint and use. Second important thing is FOMC minutes. And I will write down what I'm expecting or what could be the triggers on these minutes, which could push the market direction. Now, in the last few days, there were many Fed speakers who came and did press conferences, or they part of bigger events where they're trying to showcase what's happening in the economy and giving their thoughts on how to address the inflation. So all the Fed speakers were very clear that they want to manage 4 to 5.5 interest rate, because inflation is high. Second thing, and this is around 3.25 currently, which is the Fed rate. Now, inflation last time was 8.3. Now, people think that yes, crude prices have come down and it will have a ripple effect on the inflation. Yes, it has, but it is not a part of the CPI. CPI is a part where you're actually spending on the retail stores, or you're spending money on restaurants, or spending money as a rental. Now, rents have gone up, and rents have gone up because there is less demand for the houses. With higher interest rate, the amount of per month EMI has increased to $1,000, and in a similar ratio, rentals have also gone up. Now, rentals will still go up, but condition is or choice is usually people jump onto the rentals during the start of a school year, which would have been like September. Now they are there. Even if the rental prices are going down, they will have lesser impact because now they're already a part of it, and the rental prices will change over a period of next 6 months, or if somebody has a contract of 1 year, after 1 year. Now, in this case, the PPI is suggesting that yes, we might have those small increases or small deviations in inventory, and as a result of those inventories, the demand for the raw material is less. The demand of raw material shows the PPI may be a little lean. That will pass on to the CPI. Second thing, rentals have already gone and touched. We have no new event for Fed until November now. So the rentals will not move because the interest will not move until that period. So be mindful of that fact that yes, we are right there where we should see maybe small or maybe inline CPI. I'm not expecting a higher CPI. CPI should be, hmm, let me just check the CPI. Where is CPI? CPI for this week, आएगा ना? Yes, it's economic calendar for this week. So this week, CPI expectations Wednesday and Thursday. So CPI expectation is 8.1. Even they are expecting a little uh, like lean from the previous 8.3. So if it comes around 8.1, then you can actually see market taking as a thumbs up. And that's where we come into the FOMC minutes. Now in FOMC minutes, uh, did I delete them? Oh God. So in FOMC minutes, you need to be watching for two main things. First one, that they are dependent on CPI data. They are not going to increase the rate unnecessarily. They are data dependent. If you see this term in today's minutes, not today's, tomorrow's minutes, and you see CPI 8 or less than 8, like 7.9, you can see a very big move on NASDAQ. On the contrary, if you see CPI going higher, 8.3, NASDAQ futures can test 10,000 in straight line. My thought process, we are at 8 to 7.9 max. We are not lower than this, but we should be lower than 8.1, which is the main number. Second is the balance sheet reduction. Now, as of now, they are lenient towards the balance sheet reduction. Now, balance sheet reduction is another way of reducing the liquidity in the market. Now, when we are talking about liquidity, how does it impact all of us? How does it impact the stock market or the economy? Liquidity is the dollars which are available for flowing from one side to another side. Now, how does these dollars came into the picture? I usually give an example that let's say I start with $100 and my friends start with $100. We start a business and we trade with each other. Now, the max profit my friend can have is $100, and that the total amount he will have is $200. The max I can lose is $100 and I'll become zero. It will never go above 200. Since 2008, Fed has been infusing. Uh, Initially, the goal was to stabilize the financial market, so they were doing the bond purchases. So what they were doing is they were giving the money to corporates, to financial institutions, to any company which has a grade. Now, based on that, they were asking for a very minimal interest rate. Now, and those period for bonds were 10 years, 20 years, and 30 years. So they were long duration bonds. Now, supposedly, you have a bond from the government and you are going to pay interest, and that interest was very minute. So let's say you have $100 million. Now, $100 million, once it comes with you can buy your new assets for a company. You can expand the company. You can hire new people. You can put more resources into new research, technology, and you can expand yourself, right? That's how the liquidity impacts the economy. Now, what Fed is doing right now, they think that yes, instead of providing the financial stability both in 2008, 2009, and in 2020, what Fed has done is they have inflated the assets that financial institutions are strong after a certain amount of dollars infused in them, but they have infused so much money that they were not worried about the actual valuations of the assets. For example, stocks like Zoom, it went to $600, $500. Now it is trading at $50, 90% wipeout. People were buying and they were not caring. Asset managers like Kathy Wood, she was on a roll because there was no risk evaluation. People were just buying it because every month $120 billion were coming into the market and they were just going on. Since November, December last year, when I first touched this subject, I told everybody we are going to struggle next 2 to 3 years, and people laughed at me. I told them in December, on December 15, if you can go back and watch my YouTube channel, ECB is really, really important. ECB is another head or another hand which led to this asset bubble. And they were responsible to add on through two programs. I'm not going to those programs, but they were actually putting in almost $120 billion into the US economy, US stock market across the globe. So imagine $240 billion coming every month. And in 1 year, that's about 2410, about $3 trillion, right? Those $1 trillion, where they went? They went into the housing, they went into stocks. Now they went into buying new industry, new assets, all of that. Now what is happening? Fed realized that all of this has not led to financial stability, but has led to an asset bubble, and they want to control. With asset bubble, the inflation has gone up. Inflation has gone up, consumers spending will go down. Consumer spendings will go down. They will have impact to pay their loans. Consumers earning will also go down. So that will also cause not inflation, deflation. So there are many factors which are coming right now, but US economy is still strong. Why it is strong? Because it is only addressing the bubble. It is not addressing financial instability because there is no financial instability anywhere in the US economy. So with balance sheet reduction, they will be taking out $120 billion every month from now on. If you will see, first one point was the data dependent point. Second point was balance sheet reduction. If you see anybody talking about in the minutes that yes, they need to really push on the balance sheet reduction, that will be the second big clarity that yes, they are not going to hike the interest because this balance sheet reduction will automatically add at least 50 basis points into the interest rate because it will reduce the liquidity. Now, people who are allocated those free money, it's time for them to give it back. So when they are giving it back, their spending power will reduce. When the spending power will reduce, asset will come down to its actual prices, its actual valuations, and hence inflation will come down. This is a process which they want to follow. And this is a theoretical process in terms of economics. It may take 1 year, it may take 2 years, it may take more than 3 years. Nobody knows. But this is the economic process which they want to follow. All right. Again, any questions on FMC minutes and PPI? Because these are the two important things. PPI expectations in line to little less. FOMC, they should clearly mention that they will be data dependent and they want to start the balance sheet reduction. Now, they have been very clear that there will be no interest rate cuts in 2020. So if they reach their goal of 4 to 4.5, and if they say, no, we want to stick to 4, it means we have 75 basis. Let me clear this. 75 basis points left if this is their goal for 2022. Right now, they are at 325. They have two meetings, one in November and December. Now, this minutes will clarify whether they are data dependent. As I said, second point was they are doing balance sheet reduction. Now, if they're doing this, they will be not increasing the rates. If they are data dependent, then CPI and PPI will be the main catalyst. All right, so this is what my understanding is, and I've shared my understanding with all of you. Anybody who has any questions can come onto the Zoom, and I'll try to answer best to my knowledge. Again, I'm sharing because I have learned this on my own, and I'm trying to share what I understand. I may be wrong, but that's what uh, if I'm wrong, I will learn more on this, but that's what my understanding is. Okay, let me just read your comments. Can you explain how they're going to give it back? So bonds have yields and bonds have a maturity. So on maturity, you need to return the principal amount to the Fed, and yields have coupons. It's like there is a 6 month coupon, there is a 1 year coupon. So at the maturity of each coupon, the party has to pay interest back to the Fed. Shade, if you are having a bad day in the market, think about people who purchased. You can think about people who bought Facebook at the top. So there are many companies. You can see Fastly, you can see Facebook, you can see Shopify. You can talk about, there are many stocks. CPA is calculated per month and annually. Free money also went to crypto, yes, and that's why crypto came down from 60,000 to 19,000. One more trigger, and you will see crypto going the same way like the stock market. Then let me just read the comments more. And guys, I have shared the Zoom link. If anybody's interested, you can jump over there. Game of Traders, you're a good thing. Thank you, sir. Chirag. Uh, Government is not worried about interest rent increase, and they're not going to do anything. Thank you, Goat. Everyone wait for CPI. Yes. I don't think so. It will be flat. It will be like a teaser to the big movie. Thank you, Nilesh. Yes, Ian.
Raji, can you hear me?
Yes, I can hear you.
Raji, so then does it mean that the minimum we can see, even if the numbers came less, we see a minimum 75 basis point? Is that what we're saying?
See, if CPI is less, we will still see 75 basis points. Yes.
Okay. So that means
It may be a 50 or 25. It may not be a 75, 50. But it is going to be 75 basis point at least. So they have a threshold currently from 3.25 to 4.5. So there is a difference of 50 basis points. Now, from 3.25 to 4, That's 75 basis points. Now, 75 basis points, they have 2 months. So they can do 75 in one go, or they can do 50 and 25. I think if CPI is less than 50 and 25,
So that
because
75 basis
in
is
all the
still not
meetings,
priced in, right, Baji? It's not priced in, right? That means the market will go down, right? Even
75 is priced in. 75 this month and 50 next month is priced in.
oh, it's already priced in.
It's already priced in. But 50 and 25 are not priced in. So I'm saying a precursor will be tomorrow morning PPI numbers. I'm assuming they will be light because
Okay.
there is deflation. As I see, if you go to Walmart, you go to Macy's, their stuff is not getting sold. Inventories are increasing simply.
Okay.
Same thing if you saw Nike's result, right? Their inventories were increasing. Take a cue. That's why I ask everybody to read the results. Just don't look at the Twitter or news. Read the results. What is coming out from these bellwether companies? Like
I-
tomorrow, if Caterpillar or John Deere something about the economy, like FedEx said so, that yes, they are struggling with the cost and supply chain issues.
Okay. Okay. And but do you think that the midterm elections will have any effect on this in the November?
Again, that I have answered this 1,000 times. There is no impact. Did Biden even came once to say, let's hold the market? So why you want to go and see that yes, midterm will change anything?
Oh, okay. So
See, that's a perception which people who do not know the market, they just spread around that yes, midterms are coming, we will see a overshoot of the market. But why? If something has to happen, that will happen in 2024 when president will change. Senate is not going to Republicans. Congress is not going to Republicans. And they are not going to have any change in the policies. They are just keeping their eyes shut uh, with respect to the stock market. Uh, all right. Okay, let me just do a quick ES and NQ because that's the two things I want to do. So again, this is ES, and I will not post this levels because I'm not preparing the entire sheet. So I'm just talking about these levels. So if you want to make a note, please make a note. Yes, Ankur. Nick Jan, that's a different topic altogether. Recession does not mean, uh, see, uh, we are already in recession. It's just that we are in a technical recession already. We have two back-to-back quarters of negative growth. All right. Stock market has accepted that and it's down almost 25%. It can go down if recession, actual recession, meaning where job losses will increase and people are panicking, stock market can go to 30 to 40%. That's pretty fine because there are gaps on ES which will require the gap fills. And I've told everybody every time I do these sessions, gaps will be filled no matter what you do. It may take 1 year, it may take 2 years, it may take 5 years, but all the gaps will be filled. So keep that in mind. So in case CPI comes at higher, let's say 8.5, market will go down all the way to 3,400. That's the very first big support because it was a support of pre-COVID highs. If we lose that, we do not have good support until 3,200, 3,100. Nick, you can actually check that. I do not have those handy right now. I roughly remember around 2,800, no, 2,400. There are gaps. Okay. See, once we talk about all this, I get deviated from my agenda. You can simply go to your chart and do some exercise, and you will see this is the gaps. This is, yeah, there are gaps here. ES gaps right here before the W and right here. There were gaps right here. So these gaps will be filled. All right. So let's go to the ES. So ES today again, you like it or not like it, you question it. It came and tested this trend line support, which I call as mother father support, because this is the main trend line in my regression channel. This is like mother father support, and this is the grandfather support, the dark green line. If we lose this, we're gonna go down big. If we lose the grandfather support, we are going to go down massive, because then we are out of the regression channel and we do not have any directions. So if we have to bounce, like previously, we just came down in July to that area. This is the grandfather support area. We made a morning star right there. And then from there on, we just did a rally from 3700, it was 3639, 3639 to all the way 4327. That's about 680 points. Now we are at the same juncture right now. If we lose this, then we'll come to the 3400 area, which is like a grandfather support area, dark green line. Now this line is really, really important. This is pre-COVID high. So if we lose this, then market is in real trouble. And that's where panicking will start to happen in the market. There will be margin calls, there will be issues at this juncture, 3400. Until then, this is a very big support area where we can bounce. We are making dodges here, not full-fledged dodges. If you go back to a weekly frame, right, we are right there. We had 1 week red, two, three, then we had a green, which was bearishly engulfed, then green, then red, red, a hammer, and right now we on this. Usually a hammer is cleared by a big move, but right now we have not seen that. But there are still 3 days left in the week. If we close 3660, or if we can touch 3660, there could be a very, very big move coming into the market. But right now we are at 3600. Your support is very confined. This was 3575. Now it is in the same range, 35, uh, 3575. Yeah, 35. Like I gave a range 3575 to 3585. The range is same, 3575, 3585. If you lose this area, do not even think to go long. If you hold on to this area, and again, uh, if we bounce and we bounce and hold the range 3595 to 3575, 3585, these are good support areas, because even today, I went long and I recommended long on ES at 3607, and we booked profit at 3625, 26 and 3640. I wanted to see it can go higher, but it did not, and it retraced back. And I put that information again on my learning channel, that yes, if it loses 37.5, 35.95, not 37, 36.5, 35.95 range, it can go down, and it did, made 35.80 and then bounced right from there. So you need to be very careful. If you are not in the front of the screen, do not trade. If you are trading, reduce the size, keep it to minimal, and trade only when you're certain. If you're not certain, do not engage yourself in a trading. You need a catalyst. Right now we are in a very tight range between 3660 and 3580. That range needs to break out or break down, and wherever it will happen, it will give you 2 to 3 days of continuous moves. So don't worry if you missed the gap up or gap down after the CPI or the PPI. It's better to enter once you understand. Do not jump into the futures right at 8:30 thinking that you can make $1 option to $10 or one future is a 50-point gain. It is going to be volatile, so no. So in this case, I will still say 35, 75, 35, 85, 35, 95, roughly 3600 below. There are three support levels which needs to be held. If we lose 35, 75, this 35, 71 will go. We will directly hit 3500 in straight line. If we bounce, we have a issue at 36, 35, the number right here. We have what you call a resistance at 3660, 3691. 3691, if we cross, things will change dramatically. Then we can see 3800 in straight line. So 3691 is 12 EMA, 3691 is the long-term trend line. If we regain that, if we close above that, we will see 3800, and that is possible by the end of this week. And it will confirm the hammer bounce. And Joe, you were asking whether we have a bearish engulfing. No, not yet. Bearish engulfing will become once it covers this entire green body. Second thing, the week is not finished yet. So I will not assume that this is an engulfing candle as of now. So as of now, my bias is I'm bullish on ES that we may bounce because there is a W in making right here. Also, we are testing and bouncing. Now, these tests have been done multiple times. If we lose this test one more time, we will fall. But if we break above 3660, 3635, 3635, 3660, we have a goal of 3691. These three numbers. So that is ES, NQ. NQ is away from the long-term support channel. So its support comes around 10,550, 10,550. So it's in middle of nowhere. That's why if you see today, NQ was relatively weaker than ES because ES was near to the trend line, but NQ is far away from the trend line. If it loses, it has no stopping until 550. So keep an eye on NQ. You should only jump on NQ if you cross 11,000. Do not jump before that. 11,000 is your trigger. You can see 11,255 and 11,600. On the downside, 1050, 10,550 and 10,000. These are the next two areas for NQ. 10,000, yes. 10,000 will be very, very nasty for NQ. And when NQ will test 10,000, Apple will come down to 125, 120. Amazon will 100. Tesla will be 180. So if you want to engage yourself in long-term puts, you need to be watchful. If we lose today's low, 10,767, we should see 10,000 right there. It is also making a head and shoulders. So possible move is there. So guys, that's about it from me. I don't have anything else. I hope I'm able to give you certain information which you can use. Okay, Bank of England announcement did not spark the last hour sell-off. It came well before the last hour. So what Bank of England is saying? Bank of England is saying that, and this is what Fed is also saying, that they are not responsible for the financial institutions. They are not responsible for the banking. They are not responsible for the companies. They are responsible for the financial stability of the country, and they are responsible for working out the central bank operations, which is not to do uh, like provide more buying to the bonds, and that provide money to these companies. That's not the main job of the central banks. Now, when they say so, he has clearly said that all the pension funds, all the hedge funds, all the big funds across the UK, they have ample amount of money. There's no liquidity shortage because they have been pumping money since 2008-9. So they are saying that they will do the bond purchase program until this Friday. After that, they are not going to do it. They're stopping it for a undeclared time, and then the market has to be managed by these pension funds. They need to bring in that kind of money to make sure that yes, market is stabilized. I can give you an example. A few years back, maybe like 10 years back, when Indian market was struggling, then the finance minister and the RBI governor used to ask LIC, Life Corporation of India, Life Insurance Corporation of India, to intervene and do buying so that the prices of the stocks can be managed. That's what the same thing has been requested by the governor of Bank of England, that yes, to manage the stock market, to manage the companies, the pension fund should come and start to do buying so that they can hold onto this. Because pension funds are full of money. They have enough capital to support the market. Now, the market went down because of this and because of the comments came from the Fed governor in the discussion at 3 p.m. There it led to the fall in the market. Second, they were nervous about the PPI. So with the commentary coming from the Fed uh, speaker, that add fuel to the fire, and then the market just gave up. So it was from 3650 all the way to 3580. That's what happened. Again, that's my understanding. I could be totally wrong because you can see there are multiple perspective of looking at the information. So I'm just sharing what my thought process was. So I've shared PPI, I have shared the information regarding the FOMC minutes. I've shared my thought process on ESNQ and the Bank of England. And that will be it from me. If you finding this information useful, I would recommend you to like it and share it. And I'll just post this on Twitter. If you can do a retweet, I'm more than happy. And people who are asking about my learning channel, if you want to join my learning channel, you need to ping me on Twitter. And if you are only interested in the public info, I have a public channel where you can see some of the information which I share. All right. So thank you all. Have a wonderful night, and I'll try to see you tomorrow morning. Good night, guys. Bye bye.